All right, good afternoon, everybody. I see we have a lot of folks joining us here, and everybody's going to continue to be admitted so that everybody can join the call. Want to thank all of you for being here today. I'm Congressman Ryan McKenzie, and this is another in our series of webinar topics that we're going through over the course of the year. This one is on the One Big Beautiful Bill Act, and it relates to all of the tax code changes and tax credit changes that are applicable for the tax year 2025. It's a session that is intended for general information and also some technical assistance, but it's for individuals. We have a separate seminar that is going to be hosted on Wednesday, February 18th at 3 p.m. That will be focused on business owners and small businesses to talk about the provisions of the tax code that were changed that may relate to them and their business. But just want to thank all of you for being here. There are a lot of very positive changes that were made in this tax code that are going to help all individuals with an expanded standard deduction, but also changes for seniors to change their deduction for Social Security, individuals who are tipped workers, overtime workers, an expanded child tax credit, so many different components to learn about today. So appreciate everybody being on the call. And with that, I'm going to turn it over to Sarah, who is our outreach director, for a little more information. Thank you and enjoy the call.
Thanks everybody for joining us today. Just want to go over a few housekeeping items. First, we would like to note that this is a nonpartisan informational call and will not include discussions or opinions on new policies or legislative processes. So we ask that questions on this call today remain focused on the implementation and available resources relating to individual tax provisions for 2025. But you can feel free to contact us by calling one of our offices or visiting our website at mckenzie.house.gov to share your thoughts and opinions on other items. Mics will be set to remain muted for the duration of this program, and if you have any questions, you can place them in the Q&A or the chat box. We will be monitoring both, and after the completion of the presentation, we will go through questions and answer them as time allows. Also want to reiterate that tax situations are highly individualized. We'll cover common scenarios and try to answer all questions on a generic level, but not all questions may be addressed during today's webinar. If your question appears to require a deeper review or we cannot get to your question in due time, a member of our team will follow up with you after the call to learn more and help you connect you with the appropriate resources. Please remember today that the information shared is for general educational purposes and should not be considered individualized tax or legal advice. And for advice specific to your situation, you may wish to consult with a qualified tax professional. This webinar will be recorded and will be posted onto our website upon conclusion as a resource for those who could not attend today, or so you can go back and review the information on your own time. I will additionally send out a follow-up to everyone here to notify you all of when that recording is available to view, along with additional information on the upcoming webinar that the Congressman mentioned, specific for business filing. So with that, I would like to introduce Katie Hunyadi, who is a congressional liaison with the Internal Revenue Service, and she'll be conducting the presentation this afternoon. So Katie, over to you.
All right. Thank you so much for having me. I am excited to talk about this and share information with all of you that I hope is helpful. As you heard, today I'm going to be talking about the individual tax provisions that are included in the new legislation, the One Big Beautiful Bill Act. I do want to let you know that some of the information you're going to hear it a couple times because it applies to various provisions of the act, but I just want to be thorough and make sure that you understand all of the details of all of the provisions that we're going to be hearing about. There won't be a test at the end, but but you'll probably be an expert on some of the aspects of the provisions by the end. Also, all of the information that I'm sharing today is available on irs.gov. We have a dedicated section for the OBBB, as we like to call it, and also the text of the actual bill is available at the Library of Congress website as well, if you'd like to take a look at that. I muted myself instead of advancing the slide. Sorry about that. Okay. So first we're going to talk about the no tax on tips provision. And this basically says that an individual can deduct qualified tips that are received in a job that customarily and regularly receives tips, and this is going to be in effect from the 2025 tax year through the 2028 tax year. The deduction is limited to $25,000 per year, and it does begin to phase out when the adjusted gross income of an individual exceeds $150,000. That figure is doubled for joint filers, so that phase out would begin at $300,000 if you are married and you file a joint return. Qualified tips that are received by a self-employed person are deductible, but only if the business's gross receipts are greater than its deductions. Employers are required to report the qualified tips on a Form W-2 for their employees. And if you are someone who doesn't receive a W-2, or if your employer doesn't provide it, then you can self-report your tips via a Form 4137. For individuals who are non-employees and maybe work as independent contractors or consultants, for example, you would likely be receiving a Form 1099 of some style, maybe a 1099 NEC, a 1099 miscellaneous, or even a 1099K, and those forms would have the information that you need included as well. So any amount that does not meet the rules for a qualified tip does not qualify. Just want to put that out there. And also, the deduction is only allowed if the taxpayer's Social Security number appears on the tax return. And also, if you are married, you must file jointly in order to claim the deduction. All right, as I mentioned earlier, the qualified tips are cash tips that are typically received by an individual working in a job that regularly receives tips. It is important to know that a payment does not count as a qualified tip unless the customer is giving it voluntarily and without any penalty for not paying. The amount is not negotiated or set by the business, and the customer decides the amount to pay. So if you had a situation where, sometimes restaurants will have an automatic service charge or a set gratuity for a large party. If amounts are collected as part of that set service charge and they are distributed to workers from this, then that is not considered a qualified tip. Also, a business where a person works that is considered a specified service, trade, or business is also not qualified for this deduction. I will get into more detail about what that is in a minute. So if you're wondering, don't worry, I'll explain in a moment. And finally, any amounts that are received for illegal activities such as prostitution, for example, would also not qualify as a tip. All right. Another aspect, I did say qualified tips must be paid in cash, but they are also paid in cash equivalent mediums such as a check, a credit card, a debit card, a gift card, or another form of electronic settlement or a mobile payment app such as a Venmo or Cash App. Treasury and the IRS did issue a news release 2025-92 that provides guidance on the occupations where workers are customarily and regularly receiving tips under the OBBB legislation. The 8 categories that you see listed here are where those occupations fall, and there are 68 that are currently included. Okay, I think I covered all of this, but I just want to make sure this is some of the information that we'll be hearing repeatedly. I didn't mention the first one, and that is if you are filing a return and you use the standard deduction, you are still able to take the deduction regardless whether or not you itemize. So you can choose to itemize, you can choose the standard deduction, and you are still entitled to claim this deduction. Also, if you are married, both spouses must file a joint return in order to claim the deduction, and you must include your valid Social Security number on the return. If you do not include the Social Security number, then the IRS will treat this as a clerical error. The deduction will be disallowed, and then any changes in income will be assessed, which could result in a lower refund or an increased tax liability. So make sure you are including your Social Security number. If that happened, you could file an amended return to correct it, but that's better avoided if you can, just to make sure things are processed more efficiently. Okay, so as promised, I am going to talk to you about a specified service trade or business, also known as an SSTB. This is the kind of business where the value of the business comes from the skill or the reputation of the owner or the employees. And some examples would include industries such as healthcare, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, and also investing or investment management, trading, dealing, and other such similar business types. Unfortunately, if that's the type of business that the employee is working in, then any tips are not considered eligible for the deduction. All right, so the reporting aspect of this for this current year, 2025, the W-2s are the same. There aren't any changes to them, and employers will be using the current form. There are no new boxes or codes that reporting the tax-free tips or the overtime, which we'll talk about next. Also, the IRS will not be imposing any penalties for employers who are not able to separately capture the tax-free tips on the W-2 this year. So if your employer is struggling with that, you can go ahead and report your tips via Form 4137 when you file your tax return. Generally, your employer is required to provide the amount of tips that you receive as well as your occupation. That's generally reported on the W-2. And similarly, if you're a non-employee, then the service recipient who would be issuing you a 1099 would also report the same kind of information. And that would be reported to both the IRS and the Social Security Administration, just in case you didn't know that. All right, so for next year, there will be a new Form W-2. It will not include new boxes. So that box 12 and 14, they're on there for this year as well. But what is changing is that there will be new codes so that we can qualify tips and overtime, and we will be able to use that when we process the tax returns. So we are asking that employers are updating their payroll systems this year so that next year we will be able to have the tips and overtime easily available so that we're able to process the returns efficiently and get refunds out. All right, so we are moving on to a new provision, very similar in detail to the one we just discussed. It involves qualified overtime pay. This one also applies for tax years 2025 through 2028. The deduction amount is limited to $12,500 per year for single filers. That is doubled for joint filers. It does also have a phase out that begins at $150,000 for single filers, and again, that's doubled for joint filers. Qualified overtime pay means pay that an individual earns under the Fair Labor Standards Act of 1938, and that would be the pay that exceeds the individual's regular rate. The qualified overtime, just like the tips, is required to appear on the W-2 or the 1099 for non-employees. Same transition rules apply for the tax year 2025. If an employer makes a good faith effort to report wages or tips and overtime, then no penalties will be assessed. All right. As we saw before, the deduction is available for those taking the standard deduction or for itemizing deductions. Again, that Social Security number needs to be included on the return. and taxpayers who are married must file jointly in order to claim the deduction. That's one of those recurring themes that I mentioned. I'm sure you've gathered that by now. All right. So now we're going to talk about another new provision, which is the car loan interest deduction. This again applies for tax years 2025 through 2028. And this says that an individual can claim a deduction of up to $10,000 for interest paid or accrued on a loan taken after 2024 to buy a qualified passenger vehicle for personal use. The deduction begins to phase out when the adjusted gross income exceeds $100,000 for single filers, $200,000 for joint filers. And again, this deduction is available whether you take the standard deduction or you itemize. So qualified passenger vehicle loan interest is the interest paid or accrued during the tax year on a loan that is taken out after December 31st, 2024. And it is used to buy a new passenger vehicle for personal use. The loan must also be secured as a first lien on the vehicle. For this rule, debt does include any refinance loan, but only up to the amount of the original loan. It does not include any loan owed to a related person. Also, this type of qualified interest does not include any interest paid or incurred on a loan to finance fleet vehicle sales, a loan to purchase a commercial vehicle, any lease financing, a loan to buy a vehicle with salvage title, or a loan to buy a vehicle intended for scrap or parts. A qualified vehicle does include cars, minivans, vans, SUVs, pickup trucks, or motorcycles with a gross vehicle weight rating of less than 14,000 pounds. And also the final assembly must have taken place in the United States. If you're not sure whether that assembly took place in the US, you can usually find this information on the information label attached to the vehicle on the dealer's premises, or you can use the VIN number to find out. The National Highway Traffic Safety Administration has a VIN decoder tool on their website, and you can input the VIN number there, and it will give you the information that you need, including whether or not the final assembly has taken place in the US. The original use of the vehicle must also start with the taxpayer, which is a confusing way of saying that a used vehicle will not qualify. And also imported passenger vehicles also don't qualify because they don't meet that test of being assembled in the US. Okay, finally, the interest will only qualify if the taxpayer lists the VIN number on the tax return when it is filed for that year. It would go on a Schedule 1A. So it's similar to that SSN requirement. You have to include the VIN number or the deduction will be disallowed. Okay, lenders or other recipients of the qualified interest must file the information returns with the IRS. They are also required to provide statements to the taxpayers which show the total amount of interest that is received during the taxable year. Again, the IRS will be providing transition relief for this provision as well, allowing lenders to update their systems to allow for the new reporting requirements. All right, another new provision. So, any taxpayer who is age 65 or older by the end of the tax year can claim an additional $6,000 deduction on tax returns, again for 25 through 28. And for a joint return, both spouses can qualify individually if they both meet the age requirement. The senior deduction begins to phase out when the taxpayer's adjusted gross income is $75,000 or double for joint filers. Again, this can be claimed if you itemize deductions or you take the standard deduction, and you must include the Social Security number of each qualified individual on the return. Please do note that the Social Security number must be valid to authorize a person for work in the US, and it must be issued before the due date of the return. Okay, so those are the big new provisions that I wanted to mention. Now I'm going to talk about a bunch of other provisions where there is some new information, and in some cases, there are provisions that have been in place, but they are being made permanent. So I just want to make sure you guys are aware of that. So first and foremost, the current income tax brackets that were established in 2018 at lower amounts will stay in place permanently. These range from 10% to 37%. And they had previously been set to expire after this tax year, but they will not. Also, the higher standard deduction amounts will permanently increase to $15,750 for individuals, $23,625 for head of household filers, and $31,500 for married filing jointly filers. The personal exemption is also permanently eliminated. We haven't had that for a few years, and we won't be seeing it again, at least not for now. All right. The basic standard deduction amounts, also established in 2018, are made permanent, and they are increased starting for this tax year as well. Also, taxpayers can receive an additional deduction amount if their adjusted gross income is below $75,000 for single filers or $150,000 for joint filers. If your income meets or exceeds the filing threshold, you are legally required to file a tax return even if you don't owe tax. I think sometimes people are confused about that, but it is legally required if you do meet the filing threshold. If you do not meet the threshold, you would not be required to file a return. But if you are eligible to claim any refundable credit, such as the child tax credit, the earned income tax credit, or the adoption tax credit, then you should file a tax return in order to claim any refund that you would be eligible for. Otherwise, you can't receive it. Okay. The reduced dollar limit for the home mortgage interest deduction is also now permanent. You can only deduct the interest on an acquisition debt of up to $750,000, or if you're married filing separate, you can have half that amount. The temporary suspension for the deduction for home equity loan interest is also now permanent, and taxpayers can deduct mortgage insurance premiums as home mortgage interest. The state and local tax deduction, also known as the SALT deduction, limit for individuals who itemize is temporarily increased for tax years 2025 through 2029. And the limit for this filing season is $40,000. If you're filing separate, it would be $20,000. And these amounts will be increased 1% per year moving forward, all the way through 2029. So that means that in 2030, the SALT deduction limit reverts back to $10,000 or $5,000 if you're filing separate. Starting this year, the child tax credit increases to a maximum of $2,200 for each qualifying child under the age of 17. The credit amount will be adjusted annually for inflation after 2025. And the following rules have been made permanent as well. The $500 credit for other dependents, the income phase-out thresholds of $400,000 for joint filers and $200,000 for single filers. The $1,400 refundable limit for the additional tax credit, child tax credit, is also made permanent. The $3,000 earned income threshold for the additional child tax credit eligibility is also made permanent. So, as I said before, a taxpayer cannot claim the child tax credit unless they file a return, and they also must include the Social Security number of both the taxpayer and each qualifying child. And as I said, with the senior deduction, the Social Security number must be valid for work purposes in the U.S. and issued prior to the due date of the return. The maximum credit rate for the child and dependent care credit increases to 50% of the qualifying expenses That rate will decrease when the adjusted gross income goes above $15,000. So at $15,001, the rate would drop to 49%, and that would be for AGI up to $17,000. So the rate will continue to decrease proportionately until it reaches 35%, which applies at the $43,000 threshold, and that would apply up to $75,000 for single filers. As you might imagine, those figures are doubled for the joint filers. Also, for taxpayers that have an adjusted gross income over $75,000, the credit percentage continues to decrease until it reaches a minimum of 20%. The 20% rate applies to adjusted gross income above $105,000 for single filers, $210,000 for joint filers. Also, starting in the 2026 filing season, so this will apply next year, taxpayers will be able to contribute up to $7,500 per year to a dependent care flexible spending account. If you are married filing separate, you can contribute $3,750. All right. The 60% limit on cash charitable contributions made by an individual to a public charity is also now permanent. An individual who does not itemize deductions can still claim a charitable contribution of up to $1,000, $2,000 for a joint filer, and this is for cash donations made during that current tax year. Individuals who itemize starting in 2026 will have to apply a 0.5% floor to their charitable contribution deduction. So this means that only the portion of your contribution that exceeds a 0.5% of your AGI will be deductible. All right. The temporary repeal of miscellaneous itemized deductions is also, that were subject to the 2% of the AGI, is also now permanent. So what this means is certain itemized deductions are no longer, including job-related expenses and tax preparation fees. However, eligible educators can still deduct certain work-related expenses for things like books, supplies, computer equipment, and other materials that are used for instruction. In order to be eligible, the educator must be a teacher, an instructor, a counselor, a principal, or an aide working in a K-12 classroom, and interscholastic sports administrators and coaches who work at least 900 hours during the school year. Educators can claim an above-the-line deduction of up to $300 for classroom expenses. In addition, they can also claim an itemized deduction for any additional expenses above that $300 limit, as long as the expenses are for items used as part of the instructional activity. All right, now let's talk about the Trump accounts. These provide for tax-exempt accounts for children, which are similar to an IRA. The annual contributions are limited to $5,000 a year, and U.S. citizens born between January 1st, 2025 and December 31st, 2028 may be eligible for a matching $1,000 from the government. The maximum amount of qualified higher education expenses that may be used from a qualified tuition program, such as a 529 plan for elementary or secondary school enrollment, is increasing to $20,000 per student per year. This includes students who are studying abroad. The definition of these higher education expenses also now includes qualified post-secondary credentialing expenses, which expands the type of education costs that qualify for tax-free distributions from a 529 plan. Starting with distributions made after July 4th, 2025, the definition of qualified higher education expenses for elementary or secondary school attendance includes tuition, curriculum, books or instructional materials, online educational materials, tuition for tutoring or educational classes outside the home, as long as the tutor is not related to the student and is a licensed teacher, a former instructor, or a subject matter expert. fees for standardized testing, including achievement tests and advanced placement tests, or any college or university entrance exams. Also included are fees for dual enrollment at an institution of higher education. And finally, educational therapies for students with disabilities, including occupational, behavioral, physical, and speech learning therapy. I did mention earlier that now post-secondary credentialing expenses are included. These are for programs that are recognized and meet certain criteria, one of which being that they are included on a state list under the Workforce Innovation and Opportunity Act. Starting with tax years 2025 and beyond, up to $5,000 of the adoption credit is now refundable. This amount will be adjusted for inflation for tax years after 2025, and the refundable portion of the credit cannot be carried forward to future years. Only the non-refundable portion may be carried forward. Indian tribal governments also now have the same authority that states do, to decide whether or not a child has special needs for the purposes of the adoption credit. Shifting gears a bit here to talk about disasters. The special rules for claiming qualified disaster-related personal casualty losses now applies to any area declared a major disaster by the President under the Robert T. Stafford Disaster Relief and Emergency Assistance Act. These rules cover disasters which were declared between January 1st, 2020 and September 2nd, 2025, if the incident period began on or after December 28th, 2019. The temporary rule that limited personal casualty and theft loss deductions to federally declared disasters is now made permanent, but it has been expanded to include certain state-declared disasters as well. Okay, now we're going to talk about some of the tax credits for clean energy and clean vehicle credits and what's happening with those. So the tax credits for the clean vehicles, both new and previously owned, are now terminated, and they may not be claimed for vehicles acquired after September 30th, 2025. The energy efficient home improvement credits are also now terminated, and a taxpayer may not claim the credit for property placed in service after December 31st, 2025. Qualified residential energy property expenditures includes any oil furnace or hot water boiler placed in service before January 1st, 2026 that meets or exceeds the 2021 Energy Star efficiency criteria. Similarly, the residential clean energy credit is also terminated. A taxpayer may not claim the credit with respect to any expenditure made after December 31st, 2025. The credit amount remains 30% of the taxpayer's qualified expenditures made before the end of this year, well, last year, and for property placed in service after 2021. So just to reiterate, the clean vehicle credits cannot be utilized for vehicles purchased after September, and the residential energy credits and home improvement credits cannot be used for expenses incurred after December 31st, 2025. So there's just a slight difference there, and I wanted to point that out. Okay, starting with tax years after 2025, taxpayers can deduct only up to 90% of their gambling losses, and only to the extent that these losses do not exceed gambling winnings. This new 90% limit can result in a taxable income even if no actual gain occurs. For example, if the taxpayer wins $100,000 but also loses $100,000, they may only deduct 90% of their winnings, which would be $90,000. So this would create $10,000 of taxable income, even though the taxpayer essentially broke even for the year. Also, individuals may now permanently roll over funds from a qualified tuition program, such as a 529 plan, to an ABLE account if the ABLE account owner is the same person as the designated beneficiary of the 529 plan, or the ABLE account owner is a family member of the beneficiary. And the rule that allows extra contributions to an ABLE account by the designated beneficiary is now permanent, subject to the existing annual limits. Contributions are also permanently treated as eligible for the Retirement Savings Contributions Credit, or the Savers Credit. Starting after 2026, the maximum Savers Credit will increase to $2,100 per year. Also, beginning after 2025, qualified hazardous duty areas are permanently treated the same as combat zones for tax purposes. This means that members of the U.S. Armed Forces serving in these areas will receive the same benefits as those serving in official combat zones. The following locations are qualified as hazardous duty areas currently: the Sinai Peninsula of Egypt, Kenya, Mali, Burkina Faso, and Chad. Starting after 2025 as well, the exclusion from gross income for discharged student loan debt applies only to loans discharged because of student's death or total and permanent disability. This rule is now permanent, and there is no time limit on when the discharge can occur. To qualify for the exclusion, the discharge loan must meet certain criteria, and the loan recipient must have a valid Social Security number, which is included on the tax return. See, it came back again. Also, starting after 2026, individuals can claim a tax credit for qualified contributions made to scholarship granting organizations, or SGOs, that provide scholarships for qualified elementary and secondary education expenses. The maximum credit is $1,700 per year, and the scholarship amounts received by the taxpayer or their dependent are excluded from gross income. A qualified contribution is one that is cash and is considered a charitable contribution under the Internal Revenue Code, and the donation must be used to fund scholarships for eligible students in the same state where the organization is listed. A taxpayer that is making this type of charitable contribution cannot claim both the deduction and the credit for the same contribution, and if the credit amount exceeds the taxpayer's allowable tax liability, the unused portion may be carried forward for 5 years. The total credit must also be reduced by any state credit that the taxpayer receives for the same contribution. I just want to mention the qualifications for the scholarship granting organization is they must be a 501c3 nonprofit. They cannot be a private foundation. They must keep separate accounts for the qualified contributions to prevent the funds from being mixed with other types of accounts. And they must appear on the state's official list of approved organizations for that year as well. Qualified elementary or secondary education expenses does include tuition and fees, academic tutoring, special needs services, room and board, uniforms and transportation, and computer equipment. All right, the rule that allows an employer to pay part of an employee's student loan without the employee owing tax on it is also now permanent. This exclusion applies to payments made after 2025 when the employer pays either the employee or the lender to cover principal or interest on a qualified student loan incurred by the employee. To claim the American Opportunity Credit or Lifetime Learning Credit, a taxpayer must provide a valid Social Security number. Unfortunately, a taxpayer identification number is not sufficient. Also, if the credit is claimed for tuition or related expenses of someone other than the taxpayer or their spouse, the taxpayer must also include that person's name and Social Security number on the tax return. Another added layer for the American Opportunity Credit reporting, if you claim this credit, you must include the educational institution's employer identification number on the return. Similar to the Social Security number requirement, if you don't include the EIN, then the IRS will treat this as a mathematical error and will adjust the return accordingly. Okay, we made it. With that, I think I have covered everything that is currently available for the individual provisions affecting taxes from the One Big Beautiful Bill. Please, as I mentioned before, be aware that there are resources available if you have questions. Again, the information that is related to tax is available on irs.gov. The content of the legislation is available at the Library of Congress website, and we are continuing to update the OBBB section of the irs.gov webpage as more guidance becomes available. So be sure to check back. As you did here today, some of these provisions and details aren't going to take place until the following tax year. So be sure you are keeping an eye on it for your tax planning purposes. I really appreciate you having me today. I know this was a lot of information with a lot of details, but I hope that you found it very helpful and that it is comes in handy as you are getting ready to file your taxes.
Awesome. Well, thanks so much, Kate. We really appreciate you taking the time for this presentation. Do want to apologize. Our Q&A function isn't working. Everything is toggled on our end. Not sure what's going on there. But you can post all of your questions in the chat box. It is essentially the same thing as the Q&A box. So if you have any questions, feel free to drop them there. So I'll start with a couple of questions that we do have. So Stan asked, is the overtime deduction applicable to all businesses or just certain categories like the tips deduction is?
That is a great question, and I believe the overtime deduction applies to all businesses. I don't think there's any restrictions for that particular deduction.
Gotcha. All right, the next question is from Dave. It looks a bit like a more specific question. So Dave, I'm going to have one of our caseworkers follow up with you here. As I mentioned earlier, each tax case is highly individualized and specific. So definitely want to give you the best guidance based off of your situation. So what we will definitely have a caseworker reach out to you to chat more since it is a bit more of a specific question. So Bill asked if you could please repeat the standard deduction amounts for single and married filing jointly.
Yes, I will. If you give me 1 minute to scoot back in my notes here. 1 second. Yes. Just kidding. Thought I was there. 1 second, please. Oh, here we go. I found it. I lied. Okay, I did. I found it. Okay, for the standard deduction amounts for individuals is $15,750. The head of household filers is $23,625, and for married filing jointly, it's $31,500.
Great, thanks. Dave asked about the Trump accounts for children. I know that you did go over that. I think this question was asked prior to you reviewing that information. So Dave will definitely connect with that about that to give you more information if your questions weren't answered when we follow up with you regarding your case. So the next question here is, how does the new $40,000 SALT deduction cap work, and are there income phase outs?
Okay, so I don't believe there are any income phase outs. I don't see any in the guidance that's available, and I believe that the state and local tax deduction that is typically deducted on your item when you itemize, you know, it's you can't deduct more than you paid in state and local taxes, but you can deduct up to $40,000 any state taxes that you paid and local taxes that you paid. But again, it would be as an itemized deduction. I hope that answers the question.
Gotcha. And again, here, if there are any additional questions that we have following this call from any of our constituents here, you can always feel free to reach out to our office. We have 5 office locations, 4 in district, 1 in Washington, D.C. And you can also visit us on mckenzie.house.gov to get our contact information or submit your questions electronically. And we'll be more than happy to connect you with resources and guidance to get your questions answered. Next question is, could you go over the charitable donation rules again?
Yes, I will. So, if you do not, give me 1 second. I just want to make sure I don't misspeak. Okay, I know this one. So if you do not itemize deductions, you are still able to take a deduction for a charitable contribution made during the tax year. It would not be reported on the Schedule A. It would just be on the front page of the tax return. And if you are itemizing, then what's going to happen starting in 2026, I believe, is you will be subject to a floor of 0.5% of your AGI. So if your AGI was $10,000, 0.5% of 10,000 would be, you'd have to subtract that amount from your charitable contribution deduction in order to claim it. So that would just be, you're not getting the full amount. You would take that 0.5% of your AGI and subtract it from the total. But I would suspect that would be done by the software. If you're e-filing, I think that would be built into the software program. If you're not e-filing, I think the instructions would walk you through that. I know it sounds kind of confusing and weird.
So we did get another question on Trump accounts. So if there is any way you can make a short kind of summary of the Trump accounts, so that way we can just go over them one more time for these individuals who are asking.
Sure. So the Trump account it's a tax exempt account, a new account, but it functions similar to an IRA. It's for children, and the annual contributions are limited to $5,000 a year. And for U.S. citizens that are born between January 1st, 2025 and December 31st, 2028, the government in generally is making a matching contribution of $1,000 if you put in at least $1,000 into that account. I don't really have any other information beyond that at this time, but
again, another plug for our office here. So as more information comes out, please feel free to contact us, and we would be happy to connect you with the most updated guidance that we're able to collect here. So next question, is there anything in the bill about tax on Social Security? She doesn't remember hearing anything about that. If you could talk some more about the Social Security provisions with this bill.
We don't have any guidance on that particular aspect at this time. I can't even say for certain whether or not I haven't heard any specific provisions related to Social Security income or changes in terms of what qualifies as taxable Social Security versus non-taxable Social Security. So that is certainly something that I would be happy to look into. Again, I apologize. This is all new for us as well. We're learning it right along with you guys as it's being kind of sorted through and guidance is becoming available.
Absolutely, and Kate has been a great partner here for our office, so we're certainly going to take this feedback, and as new guidance comes out, we're hoping to schedule some more programming with the most updated and current information, so that way we can get it out to all of you guys here. So the next question is again regarding Social Security, so we'll just kind of wait to hear about that. Will you get a tax credit for a new HVAC system installed before December 2025?
Yes, as long as if it meets the criteria where it would have been eligible for one of the clean energy deductions, and it's installed and paid for before December 31st, 2025, you should be able to get the credit on your 2025 tax return. Yes.
And then we have some questions. What is AGI? We see someone commented it's adjusted gross income, but can you just define that a little bit more for those of us who might not know what exactly that means or how it comes into play?
Yes, and I should have thought of that. It's something that we talk about a lot at the IRS, but it does stand for adjusted gross income, and essentially it's a line on the tax return where you take your gross income and then certain things are deducted from it in order to kind of get to your taxable income. It's a figure. So basically you start with your gross, and then there are various line items on the 1040 that where you either add to your gross income or you subtract from it, and then you get a figure called your adjusted gross income. And then there's another figure which is taxable income where you again have modified the adjusted gross income further, but it's just from different deductions that are available on the Form 1040. And it is when you're completing your tax return, you would find that figure labeled on one of the lines of the 1040. It would say adjusted gross income.
Awesome, thank you. Our next question is from Yurleni. Can you recommend a reliable tax filing location near Allentown, PA? So there are so many members in our community who are so great with taxes. So we don't do any recommendations. However, we would be more than happy to provide you with a list of area agencies that may be able to help you out so you can choose from. Kate, are there any IRS resources or databases where somebody can go on to locate some preparers from the IRS website? Anything you have like that?
Yes. So what we have is we have a database of its credentialed preparers, and that means they're either CPA, they're a tax attorney, or an enrolled agent. We don't recommend any particular preparer, but if you are looking for someone that has credentials and is licensed, then there is a tool at irs.gov that I think you put in a zip code maybe, and you let them know how many miles you're willing to look outside of that zip code, and it will produce a record or a listing of preparers for whom we have vetted records, if that helps.
Now, I think absolutely, and I will make sure also I will include a link to that when I send out all of the registered attendees a follow-up with the information on our webinar when it's posted. I'll make sure I have a link that you guys can access that website so you guys can figure out which tax professional might be best for you in the area.
So we have Sarah, I'll be happy to send that to you. Sorry, I'd be happy to send that to you so you don't have to dig around for it. If as soon as we're done, I could send that over to you.
Perfect. Coming right from the source, even better here. All right, so we have time for one more question here. Can you define what is a personal exemption, and is there no more personal exemptions with this new tax law? How does personal exemptions work this year?
Yeah, so will be no more personal exemptions. I think when the tax law last changed significantly, it was eliminated as part of the increase in the standard deduction amounts, and so I'm not sure what the definition. It was just an added personal exemption that everyone could claim, and it is no longer. So unfortunately, at least for the time being, we don't have it. But like I said, the standard deductions did increase, so it's probably kind of a wash.
Awesome. Well, thank you so much, Kate, for taking the time, and thank you everybody for joining our webinar here today. Got a lot of good feedback, and we'll continue to work on some additional programming to make sure that the community has the most updated and current tax information. So please stay tuned. So on behalf of Congressman McKenzie and our office, thank you so much for joining us, and keep an eye out for our additional programming and the information on this recording. Thanks, and have a great day.